we don't use it now at 5.4%, but we wouldn't use it if it was at 1%.
Does the T-bills rate affect Warren Buffett's investment strategy? As at second quarter of 2024, Warren Buffett's Berkshire Hathaway holds $234.6 billion in short-term US Treasury Bills, which is more than the short-term treasuries owned by the Federal Reserve, which stood at $195.3 billion as of November 14, 2024. Listen on. Warren Buffett says if things aren't attractive, he wouldn't move even if Treasury bills are at 5.4% or 1%.
This question's from Johan Halen, who writes, you're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it. And don't tell the Federal Reserve that, but prefer it. But we only swing at pitches we like, and if anybody tried to swing at every pitch, or felt that because they hadn't swung at a pitch for the last two pitches, they ought to swing at the third one or something like that. There are times, and obviously, but I would say this: I would not like to be running 10 billion now. 10 million, I think Charlie or I could earn high returns on, because I think there are just a few things that happen on a very, very small scale. But if we had 10 billion, I wouldn't basically see many more opportunities than we found. Now, it's true that something like Japan we could have done if the company had a 30 or 40 billion, and we'd have had great returns on equity. But if I saw one of those now, I'd do it for Berkshire. It isn't like I'm got a hunger strike or something like that going on. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do.
On first reading, it may appear that T-bills rate does not affect Warren Buffett's investment strategy. The next clip will reveal that the answer is not quite so simple.
When we come back, we'll ask him what the most important factor is in determining market valuations right now. Warren, you mentioned something to me in the commercial break back before, that there is one essential factor that will determine what you think about market prices and market valuations. What is that?
Yeah, I can tell you the right question. I can't tell you the right answer necessarily. The most important item over time in valuation is obviously interest rates. I mean, if interest rates are destined to be at very low levels, not necessarily as low as they are now, but very low compared to 100-year averages or 50-year averages, it makes any stream of earnings from investments worth more money. I mean, the bogey is always what government bonds yield. Now you can pick your maturity, and you see it in real estate. Real estate yields adapt quite quickly and fairly directly with interest rates of an appropriate length. But stocks don't do it as much, but it's the same principle. Any investment is worth all the cash you're going to get out between now and Judgment Day, discounted back. Well, the discounting back is affected by whether you choose interest rates like those of Japan or interest rates like those we had in 1982 before Paul Volcker took a sledgehammer to the economy. Yeah. So when we had 15% short-term rates in 1982, it was silly to pay 20 times earnings for stocks unless you felt that the world was going to change in a very material way. Well, it's a huge bargain to buy stocks now if you knew these interest rates would stay at this level. And And you could buy 30-year bonds. I mean, in Europe, they've been selling 50-year bonds. So, I mean, people are making a judgment every day. I mean, the yardstick is there. It's just a question of whether you believe the yardstick or not. But that is something we don't like to incorporate into what we'll pay for a business, but it is incorporated in the market. It's not fully incorporated in the market. The stock market is dirt cheap now if these interest rates were guaranteed for 10 or 15 or 20 years. And of course, a 20-year bond, that's you are in a sense making that kind of commitment. But that's the big thing investors have to think about.
Inflation, T-bills rate and interest rate are all intertwined in a way they could affect earnings or quality of earnings. Our analysis of Warren Buffett's answers is that T-bill rate may not be the main consideration affecting his investment decision, but it is a consideration nevertheless.